My name is Ryan Felsman. I'm a senior economist at CommSec. My best investment has been A2 Milk, which is a Chinese consumer-facing company here in Australia. It produces milk for offshore investors in particular, and what I like about the company is it's generating strong earnings growth from a growing middle class in China. My worst investment has been Telstra. I got Telstra in its initial offering, and of course it's not performed so well recently, but of course Telstra is a key component of the Australian Stock Exchange. It's a defensive telecommunications company, and I'm really hoping the latest turnaround story adds some value. Today we're looking at the financial year 2017-18 and what happened in terms of financial markets and also the global economy. And if you look at the key financial indicators up to June the 26th, the Australian Stock Exchange in terms of performance was up about 8.3%, the Dow Jones up by 13.7%, and at the same time we've also seen the Australian dollar fall somewhat. It's currently around the 73.50 level, down around 4% over the 12 months at the same time. We've also, in terms of the fixed income market, we've seen the 90-day bank bill, so the short-term interest rates, rise to two-year highs of about 2.12%. At the same time, we've seen bond yields in Australia lift by about 14 basis points to 2.64%. In terms of the commodity backdrop, oil's been particularly strong, rising by 53% to around $73 a barrel over the last 12 months. We've also seen the iron ore price lift a small amount by about 3.3% to current levels of around $63.80 a tonne, and at the same time thermal coal's up quite strongly by 47% to 114.40 a tonne as well. Gold has lagged somewhat with rising interest rates. Gold is only up by 1.4% to about $1,250 an ounce. A lot of the focus this year has been on the fixed income or bond market, in particular the US. We've seen rising interest rates from the US Federal Reserve. They've now lifted interest rates 7 times in the latest monetary tightening cycle. Interest rates in the United States are now above Australian interest rates for the first time in 17 years at a range of 1.75 to 2% above Australia's official cash rate of 1.5%. And what that means, of course, is we've seen a convergence as far as bond yields are concerned. We've seen that 10-year US Treasury yield lift by about 60 basis points over the last 12 months and has reached the highest level in 7 years at 3.12%. At the same time, the Australian government 10-year bond yield has been dragged up. It's only up by 14 basis points to 2.64%. So the US market is underperforming the Australian market as far as the bond market's concerned. But certainly what we're seeing is those short-term interest rates in Australia start to lift. The 90-day bank bill is currently at 2-year highs of 2.12%. We've seen some of those funding costs starting to lift for banks in particular. Some of those margins are under pressure, particularly into the end of financial year, certainly as a consequence of those interest rates rising in the United States. So that's something to watch for investors. In terms of the equity markets, the Australian market has had a reasonably strong 12-month period, up by around 8.5%. The ASX has lagged the US market, of course, over those 12 months. We did see the Dow Jones up by about 25% last year on that sugar hit from the US Trump administration's corporate tax plan, $1.5 trillion worth. But one thing that's been particularly positive so far this calendar year, of course, is the fact that the Australian market is now outperforming the US market. The Australian market this year is up about 2.2% versus minus 2.4% for the US. And the reason for that really is we've seen quite a lot of strength, particularly in the small companies universe. So small companies we've seen up by about 21%. Those stocks in particular are benefiting from the improving Australian backdrop as far as the economy is concerned. Investors are taking on more risk. Certainly a lot of strong demand in terms of the cyclicals, the likes of resources, agriculture, and also some of those small mining stocks have really sort of come to the fore. We've seen merger and acquisition activity and IPOs certainly lift in that space. And also the mid-caps have performed quite well as well, up around 11%. Certainly those growth rates are quite strong for those companies in particular. They're highly diversified and they have greater access to capital. They've outperformed those large cap stocks. The ASX 50 is only up by 6.6% in comparison. One of the advantages, of course, of the Australian dollar falling so far this year is the fact that we've seen some of those companies in particular that earn their earnings and revenue streams from offshore, the likes of Macquarie Bank and Aristocrat Leisure, benefiting from a falling Australian dollar, and that improves the backdrop for Australian companies in particular. The conditions are really near record highs at the moment. And what we've seen, of course, is the fact that some of those dividend yield advantages that Australia has, the dividend yield on the ASX 200 is about 4% versus 2% in the United States. That's lifted the total returns on the All Ords Accumulation Index to in the vicinity of 13%. And if you compare that to just the All Ords Index at 8.5%, it just shows that those dividend accumulation, those dividend yields really make a significant difference. And also Australia benefits from a more attractive valuation in the United States. We've seen a PE ratio for the ASX 200 about 15.5 times versus around 18 times for the Dow Jones. So really the Australian market has lagged but is picking up this year so far. Now, in terms of what's going on in the commodity markets, really the supply is quite key here. We've seen oil lift quite strongly over the last 12 months on supply restraints from OPEC and Russia. We've also seen certainly some of those supply disruptions around the world at the same time. Venezuela's in a crisis at the moment, Angolan and also Iranian production's been hampered by sanctions from the US. And certainly we've also had this announcement more recently with petrol prices near 4-year highs. Certainly that the OPEC cartel will look to lift supply by about 1 million barrels per day. In total, it may only be a net effect of about 600,000 or 700,000 barrels per day. And what we're seeing is some of that oil price strength as a consequence. So the oil price has lifted quite significantly, over 50% over the last 12 months, and is currently around $73 a barrel. The iron ore price has lifted by 3%. It's down though this year, but down about 12.5%. Certainly we've had Chinese New Year. Demand from steel mills in China has been less as a consequence of that. At the same time, there has been some supply restraint though around environmental controls in China. So really the backdrop for iron ore will be quite interesting for the rest of this year. We've got some new supply coming on from Brazil, from the S11D project in particular, and it's a big income earner for Australia, as is coal. Coal's on a tear at the moment. We've seen the coal price lift by 47% to $114 a tonne, and really those environmental supply restraints in China are really providing quite a lot of support for coal at the moment, and exports in particular from Australia are at record highs as far as 2017 is concerned. If you look at what's going on in the currencies, with interest rates lifting in the United States, we've seen the dollar index and the United States lift to around 12-month highs, of course, on the back of those rising interest rates and capital repatriation back into the United States. That's put a downward pressure in the Australian dollar more recently. The Australian dollar is down about 4% over the last 12 months and 6% so far this year, currently trading at levels of around 73 spot 50 US. Certainly, we think there may be some support for the Aussie dollar later in the year though, because there'll be a lot of focus on the US's deficit and debt situation, which is increasing on the back of that fiscal expansion. Now, in terms of what's going on in the global economy, there's several themes at the moment. So global growth has been quite robust. We've seen synchronised growth. 120 countries in terms of the OECD expanded last year, which is the best synchronised growth in about 7 years. And what we saw, of course, is China leading the way. Chinese growth was around 6.8% over the course of the year. At the same time, the US economic growth was about 3%. And of course, at the same time, Eurozone growth picked up too. But what we're seeing is some of that momentum fading in the first quarter of this year in particular. We've seen some of those purchasing manager indices, particularly from the Eurozone, start to fall back somewhat. Japan actually had a negative GDP print of about 0.6% for the first quarter. So that's something to watch this year. Once that sugar hit from the Trump tax cut starts to fade, we may see some slowing in terms of economic growth in particular. But broadly, we expect economic growth globally to be about 3.9% this year and next, before slowing into 2020. Now, of course, one of the impacts on global growth this year will be the trade wars. Economic nationalism is on the rise, particularly in the United States. There's already been the announcement of tariffs, particularly around washing machines, solar panels, steel and aluminium. They're all been implemented by the Trump administration. Tariffs of between 10 and 25% in those cases. There's also been an announcement of a further $34 billion worth of tariffs on imported Chinese products of about 25%. So what we're concerned about is if that tariff war escalates, it becomes tit for tat, certainly that may lead to a slowing of global growth, maybe in the vicinity, if it escalates further, of 0.2 to 0.3 percentage points. And that could potentially also lift inflation by 0.15 percentage points. We've already seen the US Producer Price Index rise to 3.1%, the highest in 6.5 years. One of the other things to note as well is geopolitical risks are ever present. Certainly we've had Italy recently. The Italians released their budget in September. That is a potential risk. At the same time, in Germany, there's been a lot of focus on immigration. There's elections in Bavaria. In the United States, we've got the midterm elections in November. Spain's got a new government. And of course, there's been sanctions by the United States on countries like Russia and Iran. So these political risks are having quite a significant influence on markets at the moment. At the same time, we're seeing monetary policy divergences emerge. The US is tightening interest rates. As I mentioned, interest rates there are likely to increase at least another 2 times this year and maybe 3 or 4 times next year, lifting interest rates to a level of around 3.5%. You compare that to the European Central Bank. The European Central Bank has started to taper its bond buying program down to about $15 billion by the end of this year, and then in December completely ending that program. But we don't think interest rates in the Eurozone will lift from negative levels until about September next year. And of course, the Bank of Japan's program has not changed at all. It's still got its 80 trillion yen target of bond purchasing in place at present, and at the same time, they're still targeting a 10-year JGB bond yield of 0%. So we've basically seen that divergence around the world, and the People's Bank of China at the same time, they have reduced the reserve requirement ratio for banks more recently. We expect to potentially see some monetary policy easing with a bit of a softening in Chinese growth in the last few months, but those divergences are quite key as far as markets are concerned. I've mentioned the stronger US dollar. That's having a significant impact in particular on emerging markets. So we've seen the emerging market equity index fall around 9% so far this year, and we've also seen emerging market currencies fall in total around 7%. Some of that's idiosyncratic events in Argentina and also Turkey, unique to those countries. But certainly with the strengthening US dollar, those countries have got to pay back their debt in US dollars. At the same time, they've got current account deficits in the vicinity of 5%, which means that what happens is there's a run on those currencies, that lifts inflation. In turn, the countries have to lift their interest rates, and more broadly, that slows down growth in emerging markets. So that's something to watch as well. Now, here in Australia, Australia's now into its 27th consecutive year of uninterrupted economic growth. It's a new record. Economic growth in the March quarter was 3.1% on an annualised basis, the best in about 18 months. And at the same time, we had the best quarterly result, 1% in 6 years. So what's lifting the Australian economy at the moment really is non-mining business investment, which is up about 10%. Certainly, natural gas exports are also rising at the same time, strong demand from the likes of Japan in particular. And while that's being also supported by an infrastructure boom and government spending at the same time. So we expect economic growth in Australia to remain around these trend levels, 2.75 to 3% throughout this year. The unemployment rate has come down to 5.4%. We've had the strongest jobs growth in some time in the 12 months to January, lifting to about 428,600 jobs. That's the strongest on record. That has fallen away somewhat. We're now up about 303,900 jobs for the last 12 months, but jobs growth is still very strong at the moment. The unemployment rate, 5.4%, is quite good, but what we need to see is that unemployment rate move towards that 5% notional full employment rate level. At the same time, the underemployment rate in Australia is currently 8.5%, and the underutilisation rate is 13.9%. So that suggests there's slack in the labour market at present. And with that slack, wages growth at 2.1% remains near record lows. And that's really keeping inflation in check at present, together with intense global competition in the retail space, which is keeping goods prices low. So what we need to see is those emerging skill shortages, particularly in those STEM type sectors and those industries emerge and really contribute to a lift in wages growth going forward. One of the other focuses for the Australian economy as well is the housing market. Everyone in Australia loves talking about the housing market. There's a rebalancing going on, a little bit of an engineered slowdown in some respects. What we're seeing is the bank regulator, the Australian Prudential Regulation Authority, limit the number of interest-only and investor-only loans as far as lending and mortgages are concerned, and what that limitation has really slowed down lending as a consequence of that, and we've seen places like Sydney, house prices fall back about 4%. There's a combination of reasons too. Supply has increased. The number of listings in Sydney has risen by about 20%. Auction clearance rates are only about 55% at the moment. And also demand from China. We've seen foreign demand for houses in Sydney fall by about 7%. That said, Melbourne prices are still up by 2.2%, and broadly around the rest of the country, Hobart's doing exceptionally well, up 12.7%. That's largely in the back of strong population growth, and some of those house price declines in places like Perth are starting to fall back and recede in terms of the magnitude as a consequence of the improvement in terms of the commodity and resources sector. So we're expecting house prices to maybe fall between 5 and 10% over the next 12 months. But certainly we don't think there'll be a sharp correction. We think there'll be a rebalancing taking place. And if you look at the chart in terms of the middle one there, around certainly lending, at the moment we're seeing those interest-only loans, investor loans, fall by around 15% to 11 billion. Owner-occupied demand for lending is still up 4% to about 15 billion. But affordability is improving as a consequence of that, and we've seen the number of loans for first home buyers lift by about 17.5%, which is around the best levels in 5 years. The Reserve Bank is cognizant, though, of the fact that household debt in Australia remains very elevated. And of course, that debt to GDP ratio is around 120%. And if you look more broadly, certainly in terms of the state levels, around 25% thereabouts of people in some states have debt that's three times or more their income. So the average mortgage in Australia is $400,000. So really that elevated household debt is something the Reserve Bank is really cognizant of. And if they do lift interest rates, in our view, most likely next year, it'll be in an environment where we've got tightening in terms of lending standards already occurring. And certainly as a consequence of that, we think they'll be very gradual in their approach. Now, our outlook for the rest of the year, the new financial year, is one of the things, of course, is we're seeing greater market volatility as a result of some geopolitical risks in particular, and also a normalisation of monetary policy and the rising US dollar. And as a consequence of that, investors really need to be aware of this situation and diversify and preserve their capital as a consequence. If you look at what's going on in terms of the share market, if you look at total returns, those total returns are around the 10% level versus certainly residential property, which is now only garnering a total return of around 3%. So shares are now outperforming residential property. So there's a bit of a handover going on there. And of course, cash levels with the official cash rate at 1.5%. Term deposits still remain quite low at around 2.5%. So people will need to be adequately diversified. In terms of the crystal ball, as far as our forecasts are concerned, we think economic growth in Australia will be around the 3% level. Inflation will pick up a little bit to the bottom of the Reserve Bank's 2 to 3% target on the lifting of wages growth eventually. And of course, we think the unemployment rate will start to fall back a bit. The participation rate is around record highs at 65% at the moment, and that's keeping the unemployment rate quite sticky as people feel more comfortable to go back into the workforce. But certainly we think that level will come down with quite strong job creation. The cash rate, we think the official cash rate will rise around February next year. In terms of the share market, our forecast for the end of this year, we think it'll be around the 6,500 level. And in terms of the Australian dollar, we think it'll finish this year certainly around the mid-70s where we currently are.